and good morning, everyone. And it's great to be back chatting. As Stuart says, there an awful lot going on, so we'll cover that as best we can over the next 20 to 25 minutes, and leave a little bit of time at the end of this half hour anyway to ask some questions. If April can maybe bring the slides up, that'd be great. Then we'll start on slide 3, and this normally we don't really talk about the team because there's nothing to say. But on slide 3 of our deck here, now it's not actually included in the picture here, but we do have an announcement that we just made this week that we've added a further team member to the investment team. She is Ella Cara Brown. So this is on page 3, April. So you can see that the team there, we have 5 senior portfolio managers, 3 analysts, as you know, but we've added Ella Cara Brown, who has around 20 years of experience of managing global equities. She was formerly at Aberdeen, where she'd been her entire career, and she's covered consumer, healthcare, a whole range of stocks. So we're absolutely delighted to have Ella Cara on board, and that's really just part of the growth that we've had as a team, and we're around about $4.5 billion within our strategy now. So that's just part of that kind of next generation of talent coming through, and continuing to invest in a team kind of approach, but adding a greater resource. So Ella Cara joined us on Monday, and I'm sure you will be hearing from her and more about her in due course. So we thought we'd be quite clear about that up front. So turning on to the body of what we'll talk about just on slide 4. So really, a lot going on. I'm sure you're aware that markets have been incredibly strong globally this year, bouncing back from a difficult 2022, and our fund has found it difficult to keep up, and we'll cover that and some of the reasons for that. It's been a challenging year with quite a narrow leadership within the market, and some traditional defensive areas of the market not proving to be as defensive as we might have hoped. So we'll cover that within some of the attribution, which is kind of summed up in Q3, that also reflects some of what's happened in the year to date. But then we'll turn to the outlook, and I think that is one that is evolving. Very clearly inflation is moving in the right direction, and it's most likely that we've seen the end of the kind of increases in interest rates, and the Fed are likely to go on pause. So what does that mean? What does it mean for markets? What does it mean for the direction of equities? And what does it mean for the potential companies that are going to maybe lead in that environment going forward? So we'll get to all of that and try and unpack that as we go. So moving on to slide 7, we can just touch on what happened in the third quarter from a performance point of view. So we had a correction in markets in the third quarter, primarily because we had this increase in real interest rates. And we'd had a very strong, period in the first half of the year. So for the last 1 year, markets are up 14% or 13.7%, and they were down a little bit in the 3 months to the end of September. So a bit of a correction, mainly because of the impact of those higher rates, and markets just taking a pause, to be honest, given the strong gains that we've seen through the year. And the story for our fund, we're up just over 7% in the last year, around 7% after fees, etc. And yeah, that's been a real challenge to keep pace with such a strong market. About half of that underperformance in the last year has really come from not owning the top 7 stocks, those kind of high tech and high growth companies that have rebounded so strongly in this calendar year, having been weak in 2022. And the other half of that really comes from difficulties that we've had in the healthcare sector, which was something of a feature actually in the third quarter as well, and we'll cover that as we move on. So that's the unhedged performance. Just turning on to the hedged on the next slide. It's a similar picture, very strong benchmark returns over the last 1 year, up 21%, and the market moving ahead with that narrow cohort of stocks. And we've struggled to match that on that basis as well. So very similar picture, and again closer to the benchmark over the last 3 months, but still just a little bit behind on that basis as well. So it's been difficult. So let's get into the reasons as to why that's been the case. So just turning to slide 10, we can bring that together in a little bit more kind of sharper relief, if you like. So this is a picture for what's happened in global markets, over the last couple of years, and we saw that very strong early part of 2021, and then real drawdown in markets in 2022, as that inflation fighting, the Fed becoming much more credible in their efforts to slow things down. But markets remain very resilient, and profits have actually remained very resilient. But part of that actually driven by the resilience of the profitability within the technology sector. So the technology sector now makes up almost a quarter of the profits of the S&P in the US, for example, and that's up 10 points from just 10 years ago. So the narrowness of the market, if you like, is actually reflected in the earnings of that sector, where they cut costs at the end of last year. And they've reallocated capex into more productive projects than they were doing previously, and many of them actually cut capex. So the cash flow has gone up significantly. Aside from the narrative around AI, they've actually had the best profits and have sustained the best profitability within the market. And if you didn't own that, it was very difficult to keep pace, because the rest of the market has faced quite significant headwinds. And this was the case in Q3. And that kind of magnificent seven, they corrected only down 1%, and that was relative to an all-country world index, which was down 3%. But also, interestingly, outside of the US, it really was value stocks which did particularly well, and that's been a feature throughout this year. That outside of the US and outside of those mega kind of seven large cap tech stocks, value stocks have actually performed pretty well. And as you know, we are a kind of growth and quality type style, and that's made that an additional headwind for us in this calendar year. So just turning on to slide 11, we can put this in a bit wider context. So we can see the scale of the increase in real rates that we've had. The top left is bond yields have accelerated higher throughout the year, and this was to the end of September. That's now correcting, and I think the market is probably sensing that the Fed have done their job for now, and we're going to wait and see. And inflation is very clearly beginning to move in the right direction. But liquidity has remained pretty tight, and really it's all been about the sustainability of that, of profits that have meant that markets have remained pretty resilient. So we'll need to see how this plays out, but there's some clear kind of flagging that while inflation is moving in the right direction, leading indicators, if we look on the next slide, are actually looking pretty challenging. So you can see that we're flagging something of a slowdown into next year. And, this might be normal if we look historically at periods where the Fed, hike aggressively and then go on pause. 8 months after the initial pause, we actually tend to see recession type conditions there. And then subsequent to that, we'll see interest rates coming down. So we think we're flagging a pretty sharp slowdown, but because of the resilience of these kind of very large cap kind of leading tech stocks that have remained highly profitable, the market is kind of holding up. But underneath all of that, if you look at small cap or mid cap companies, they've really been under pressure, and that's kind of, I think, because of this kind of leading indicator that's now flagging quite a sharp slowdown into next year. So we're very mindful of that. That there are still some cross currents to face, and just because the last rate hike is done doesn't mean that we're out of the woods from a demand point of view, and we need to bear that in mind as we construct portfolios accordingly. I'm sure you'll hear a lot more about that from Fergus in the next presentation. So just turning on, I think to slide 13, we can talk a little bit about attribution. So what was going well for us in the third quarter. So, it's really been, stock selection within consumer discretionary has been better for us of late. And we made a significant bet on travel and the recovery of travel and the sustainability of consumption on travel, given the kind of under consumption that we'd seen through the pandemic and that pent up demand to get back out. And as the Asian tourist increasingly begins to come back into the market now and over the next 12 months, that should sustain travel at a pretty good level. So we've seen companies like Booking Holdings, up around 60% so far this year. And Samsonite has done exceptionally well as well, for manufacturing suitcases, etc., and far more profitable now than it ever was historically. So we're seeing some benefit from that come through within the portfolio. And really, I think some of the bets that we had in the energy sector paying off in the third quarter, as we saw a bit of tightness in that market, although that has subsequently begun to shift around. As I mentioned, some of these leading indicators rolling over, and we're seeing a bit of a weaker kind of environment for more cyclical areas of the market. So that's what's been going on there. And just turning on to page 15, we can see what's been more challenging. And again, the themes in the third quarter are something that have been kind of recurring throughout the year. Less impacted now, I guess, this time by the kind of tech stocks that we didn't own in this period, but within healthcare, it's been particularly challenging. So Massimo, who have been involved in a lawsuit with Apple around their technology and how that's used for pulse oximetry in the Apple Watch. And they kind of became distracted around that kind of lawsuit and took their eye off the ball within their core business of pulse oximetry in hospitals. And we've ended up with some cost overruns and some excess inventory in that supply chain. And that caused them to have a profit warning. So unfortunately, we've seen a bit of a negative impact there. We've just met with management, and we're actually quite interested to find out that they're now talking about a partnership with Apple, rather than looking at them from a legal kind of challenge point of view, that there's a way that they could actually be integrated kind of legally with a licensing agreement into the next generation of Apple Watches. So we're quite interested to see how that pans out, and we think could be some pretty good opportunity within here. So healthcare has continued to be a difficult area, and you can see that with some of the names that are on that slide. So Tenet Healthcare, Biotechne, and Massimo, and that's really been a recurring theme within the portfolio in the last 12 months. So just turning on to I think slide 18. If we can go to that, then we'll talk a little bit about what we've been doing in the portfolio and why, and just turning on one more to page 19, we'll start to bring that to life. So as you know, we took a bet in 2022, kind of early 22, that the tech sector was quite heavily overvalued, and we're quite concerned about that. And for the latter part of 2022, that worked out very well. But then the cost cutting that's been done and the reallocation of capex towards AI has really transformed what's been going on within the sector. And I guess we were, a little bit slow early in the year to get a grasp of that. But we've done a lot of work to really look at AI in context, and I'll cover this more when we get to the outlook in a couple of minutes. But really, we found that the kind of one company which is going to dominate that new platform of computing is really NVIDIA, and it stands to probably take 80% of that value chain in a similar fashion that companies like Windows and Intel took 80% of the value chain in PC. Apple did it in smartphones, Nokia did it in feature phones before that, IBM did it in servers and in mainframes, and digital equipment did it in mini computers before them. So the evolution of computing has been such that each platform has one major champion who prevails, and we think NVIDIA are that within AI, and we're probably in the early stages of the infrastructure build out for that kind of platform of computing. So we've seen the estimates continue to rise dramatically, and actually the valuation has become much cheaper. So almost on a par valuation now, 1 year forward with a company like Coca-Cola. So far higher growth rates here, and very high returns on capital, because the operational gearing is very large and the margins drop through very quickly. So it's a very interesting company, and it's been a real explosion of demand, which has hit right into their kind of home turf. So we've added that one to the portfolio at the start of the third quarter. And I think we were very excited about the prospects for that. And then as we look further into that AI theme, we found that the data center really represents a significant bottleneck to computing and the efficient transfer of data. So companies that have kind of connectors and electrification at their core. So a company like Amphenol is one which we added to the portfolio also in Q3, and very much a very reasonably priced way to play that electrification and demand to kind of de-bottleneck many of these kind of computing platforms themselves. We added Ryan Specialty, which is a specialty insurance broker in the US, which really is taking market share very quickly within that very attractive segment of the insurance market in America, and very excited about the growth prospects within that. So really, enhancing the sort of growth characteristics of the portfolio, upping the quality, and really looking at those cyclical areas in the portfolio where have been a bit more challenged, and we think prospects are potentially going to deteriorate. So we sold Tractor Supply, which has been a very good performer for us for a long period of time. But just on that outlook for consumption as it faces into households and hard goods, which are slightly more interest rate sensitive. And actually, finally, we might see some demand impact through from that, and the same store sales begin to deteriorate, and the profitability that Tractor Supply was able to generate, through the tail end of the pandemic and coming out of that, was probably a bit of a pull forward. So we don't want to make the same kind of mistake in consumer that we made in healthcare. So we sold Tractor Supply, and similarly in Chart Industries. This is a company which is very much involved in the energy transition, but they made a very large acquisition at the end of last year, which really put a lot of debt onto their balance sheet and forced them into an asset sale. So they made that asset sale, and that caused the share price to recover, 50% more, in the past few months. So we took that opportunity to sell the stock to fund our new purchases. On the next slide, you can see some additions and reductions that we made. As you probably know, we started a position in Netflix in the previous quarter, and we continued to build that during Q3 as the shares were relatively weak and have subsequently rebounded. And we added Hoya and Synopsys, again, initial positions that we started in Q2, but we continued to build them up. Synopsys is a designer of semiconductors and silicon, so they provide the software to chip designers to develop new silicon infrastructure, and again, there's very strong demand for that. Hoya provide glass substrates into the semiconductor industry, and again, we're seeing acceleration in demand coming through there. And really, the other funding sources were just stocks that have done very well for us. Linda in industrial gases had been an excellent performer. Tenet Healthcare had done very well this year after a difficult 2022, and Booking Holdings that I mentioned, we took some profit on there as well. So, trimming to fund the build up in our new holdings. So, just turning to the outlook for the next stage. So, I think we've moved to actually page 27. Let's do that first, and we can talk about the kind of portfolio position. What's the impact of these changes? Well, in technology, we're much less underweight than we were, slightly overweight there, just over 1%. And with the addition of Netflix and communication services as well, we're less underweight there. And then subsequent to the end of this quarter, we've actually added Meta Platforms into the portfolio. Again, some of you who may have been following us for a long time know that we held that for a long period between 2015 and 2018. But we've actually taken the decision to reinvest in that, and that's happened after the end of Q3. So we can maybe talk about that at the end in Q&A. But I think we're very excited actually about the valuations and the kind of improvements in return on capital that are coming through, and the kind of shifting some of the fears that we had last year much more constructively. Industrials is an area that we've been reducing, just that cyclicality as we move into this next phase of markets. But I think we're probably slightly more concerned about that. And then on healthcare, we've held on to our overweight. I think these stocks have been put under an awful lot of pressure on these areas that people usually look to for defensive characteristics. First of all, we had the COVID cycle and the aftermath of high inventory and cost overruns and difficult profitability coming out of the pandemic. And now we've turned into you're either on the right side of the weight loss drugs and weight reduction drugs, or you're on the wrong side. And it's very myopic. And while markets are very myopic, the real world is definitely shades of grey. And it will take time for health insurers and for companies to sponsor these weight loss drugs in the numbers that are now being discounted by markets, and to actually make any difference to the incidence of diabetes or cardiovascular conditions, etc. And they're now being priced as if they're going to go away, and we don't think well, that might be the case in the very long term. There's issues around compliance of these weight loss drugs, but also who's going to pay for it, and who's going to insure it, and which employers are going to include it on their health insurance. And our meetings with companies and meetings with health insurers are such that it's a very small part of the population who are actually going to be eligible for coverage in the initial phase. So I think the market's perception of how this might play out and the reality, might just be very different. So, there are some of the kind of key features of the portfolio, more balanced within our kind of growth versus cyclicality, but retaining our exposure to the healthcare sector, and I think maintaining a kind of patient approach within that. So, moving on to the outlook, I think if we could just turn on April, so maybe a couple more slides, and just keep going through this. Yeah. So yeah, if we keep going, and so if we stop here, I think that we've titled this "The Cycle is Getting Real," and I think that's a fair point. There's no question that the Fed are most likely on pause, and inflation's moving in the right direction. The question is where it lands, and what that looks like. And the Fed won't start cutting until we see some form of deterioration in labour markets. We're seeing a little bit of that, but not much, really given the historical context. So, that kind of tighter liquidity, tighter conditions, the repricing of mortgages and the impacts on households and the interest rate sensitivity, which have been operating with a lag. But we do think it's just that, it's a lag. And it's more likely that growth starts to become impacted as we move into next year. So, what does the rate cycle look like? Does it look like Table Mountain, or does it look like the Matterhorn? Are we going to kind of a flat period where we stay on pause? And again, history would suggest that if that is the case, then we're more likely to see, a recession, at some point next year, possibly in the middle or latter half of next year. And then the Fed will be cutting beyond that. And that's most likely what we're seeing. But even already, we're starting to see around the world more countries actually beginning to, where rates are declining. So the market's starting to anticipate some of this. But it's pretty clear that that's the direction we're heading. So, what are we doing? Well, we don't want to be dependent on companies that are dependent on external financing. And we need to make sure that our businesses are self-funding. And again, that's been something of the challenge within the portfolio over the last 12 months, is that we had one or two companies that had made acquisitions at the wrong moment, and they'd really increased their debt levels, and that caused a bit of pressure on their earnings as interest rates rose and interest costs went up. And so I think it's that kind of really high quality, high return on capital, self-financing businesses that we're looking for. And I think that explains a lot of the leadership within the market within technology, is that they became the defensive companies of choice, and they've got kind of independent growth drivers, very high returns on capital, and they're capturing a bigger share of the market's profitability. So it's natural that they would capture a bigger share of the market's overall value, and that's exactly what we're seeing. And it's likely that that will continue. So yeah, just maybe turning on, we can pick up on that a little bit more from a kind of thematic point of view. So, on AI, it's the hot topic, and why are we talking about this in such kind of huge terms? And you see the growth in Nvidia's sales, which in the triple digit, the kind of the estimates for their sales numbers 2 years out have gone up 100%. Since the start of the year, which is just extraordinary given the size of the company. So, why is that? And I think what we've tried to do with this slide is talk about the evolution of computing platforms. And this goes back to the 1950s and mainframes with IBM capturing 80% of the value chain, mini computers, digital equipment, 80% of the value chain. And each time we move on, we get 10 times the number of devices connected to that platform. Then we had PCs with Windows and Intel, and then feature phones with Nokia, smartphones with Apple, as we know. And then now we think we're moving into this phase of connected computing with hundreds of millions of devices connected to that network. But that network really has a data center running AI at its core. And that's what NVIDIA can provide. So we've added several companies to the portfolio over the last few months that play into this, and we think we're at the early stages of a multi-year rollout of that infrastructure, similar to the early or mid-90s when we were rolling out the infrastructure for the internet as we know it today. And that's the phase of build out that we're in. The software and the applications and the actual uses, they come along later. But from this point, we're at the infrastructure build-out phase, and that's very much how we think this is going to go. So we're investing in companies like NVIDIA, Synopsys, which I mentioned, Microsoft, as I'm sure you're all aware, a lead player both from a cloud infrastructure point of view, but also with OpenAI and their investment there itself. And then TSMC is a key infrastructure player in the manufacturer of choice for NVIDIA semiconductors themselves. So it's a new adoption era, and we're moving through that, and we're still in the early phases of that platform rollout. We think we can see that as evidenced by the strength of the figures from NVIDIA in the last week or so. So just turning on a couple of the other themes that we've got going on within the portfolio. But actually, before we do that, we can maybe just labour NVIDIA a little more. And this just shows you the scale of market share that they've taken within the data center over the last, and this is actually in quarters. So the scale of acceleration, Intel, most of the server architecture within data centers, up until end of 2019 or middle of 2019, still 90% an Intel architecture within that data center. And you've seen NVIDIA take a huge amount of market share over the last 2 years certainly, but really accelerating over the last year or so. So a big shift, and we think there's lots of potential for that to continue from here. The last one I'll just finish on is really those enablers of AI, as I say, enablers of the energy transition. That energy paradox is still at play, and that increase in spending to sustain that transition is very much what's happening, and we're seeing good figures coming out of many of the engineers as a result of that, and that's something that's still within the portfolio